In a year where housing prices have gone up by 25%, the RBC Affordability Index is indicating that housing prices are the least affordable that they have been in 31 years. And the problem is only going to get worse.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
All right, so welcome back. In a year where housing prices have year over year gone up by 25%, the RBC Affordability Index is painting a grim picture. And this is obviously one of my favorite times of the quarter where we get to see the RBC affordability numbers. Obviously, every bank does certain things well. Scotiabank does mortgages well. BMO does investing well, and so on and so forth. TD, obviously the best bank for young people. And at the end of the day, RBC does one thing better than all the competitors, in my opinion, and that is with respect to their economic reporting. They are second to none, especially in the housing sector. And this is obviously one of my favorite times of the month because we get to see the Canadian Housing Affordability Index, which is a tool that we have used for quite some time in order to determine whether or not we should be investing in certain markets and so on and so forth. So before we get into the details of what the RBC Affordability Index is telling us, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 20,000 subscribers, where when we hit 20,000 subscribers by the end of the month, hopefully, thank you to the 19,900 of you who have already subscribed. We're just 100 subscribers away from hitting that goal of hitting 20,000 by the end of the year. And when we do, we're going to give $1,000 to one lucky winner. And then when we hit 25,000 subscribers, we're going to give away an additional $5,000. In order to enter to win, leave me a comment in this video or any video between now and the new year. And also make sure you're subscribed because you have to be subscribed to win. Now, let's get into it. Let's discuss the RBC Affordability Index. This is obviously one of my favorite topics. Before we jump into the actual details though, I want to take you into my computer screen, show you some of the headlines from this week. First and foremost, Canadian home prices surge a record of 25% amid persistent shortage. Obviously, this is coming from the Canadian Real Estate Association in their monthly report. And it's been quite an incredible year for the last 12 months. Going back to November of last year, housing prices up 25% across the country. That is one of the biggest gains we've seen. Obviously, a lot of this is to do with lower interest rates, to do with different preferences in housing, and most substantially to do with just a little bit of mania in the housing market that has led people to jump into a market before they otherwise would in order to make sure that they don't get priced out of it. And what that has led us to is a market where we are now in one of the most unaffordable that we have seen in 31 years. And I'm going to talk about what all of that means to you and why this is so important, especially from a purchase decision standpoint. But before we get into it, I want to just kind of show you the RBC Affordability Report. This is something that you can go to rbcthoughtleadership.rbc.com and find. And you can open this up, and I always like to open up not just the graphs in the news article, but I like to go and open up the actual full report and download it. If we go ahead and do that, open it up here, you can see it gives you a pretty robust detail of the market. I'm going to start by just showing you first and foremost the share of income a household would need to cover ownership costs. And this is basically the amount of income that you would need to cover your mortgage costs, your taxes, and your utilities. And what you can see is across Canada, about 47.5% of incomes, this is pre-tax incomes, so before the taxes are even taken, about 47.5% of incomes are going towards housing. You can see in Vancouver, that's up around 64%. In Toronto, it's around 61%. Calgary and Edmonton, Prairie provinces tend to fare fairly well in this report with respect to affordability. And you can see areas in Quebec and Ottawa are both bumping up against those higher numbers now. And if we go back and we take a look at the previous chart, this is where this is the actual Thought Leadership website, not the PDF report. What they have here is what shows the aggregate long-term average, which is about 40.6%. That is very much what would be deemed to be affordable across Canada, the percentage of incomes that should be going towards housing over the long term. And what you can see is that they have three lines here. The first is or the top one is the blue line, which is single detached. This is a single family home, not attached, not row housing, not a condo. About 52% of incomes are going towards that type of housing. If you look at aggregate, which is condos and single family homes, and pretty much every type of housing, they are looking at about 47.5% of incomes are going towards that type of housing. And if you look at condo apartments, still condos are very much affordable if that's the type of lifestyle that you want to live. But basically 33.8% of incomes are going towards that sort of cost of living. And the way they calculate this is really quite simple. What they do is they take the benchmark prices for type of property, and they use a 25-year amortization mortgage with a 20% down payment and a weighted 5-year fixed mortgage pricing, which is basically both for uninsured and insured. And they use that to calculate what the payment would be in each city on a typical benchmark style home. And then they use the household income to determine how much the actual income is going towards housing costs. So really simple number here, really consistent number. By the way, one way that we have used this affordability report is when we look at different markets to invest in, we typically look at this affordability report and we try to determine whether or not the market is affordable before we go and invest in it. So something we've always done is we've looked for less than 45% of incomes going towards total housing costs using this report. And if you take a look at that, I mean, if you look at Vancouver, that would typically be a city where we would avoid investing in because percentage of incomes is quite high. That is going towards housing costs. If you take a look at Toronto, again, another area we would avoid, but we've always felt comfortable with cities like Calgary, with Edmonton, and even Ottawa and Montreal, because they were still very much affordable cities. Now, this is going to get worse and worse. There's some highlights in this report that they talk about. One is that the pandemic has amplified this. The reason why we're at 31-year lows is because of the rise in interest rates over the last 3 to 4 months. By the way, we're expecting those interest rates should start coming down again because we've seen bond markets start to fall. However, with Christmas right around the corner and the new year coming up, it's widely expected that banks won't be passing on any decreases in their cost of funds to consumers until the new year, because quite frankly, they don't want their underwriting centers overwhelmed with business right around the Christmas market. So expect coming in January that you should start to get 5-year fixed rates at a cheaper rate than what they are right now. Now, there's some other things that they're looking at though with respect to affordability. And one of them is the fact that they're expecting interest rates to go up in the next couple of months, in basically the spring to middle of the year, with the Bank of Canada increasing interest rates. And they're suspecting that that is going to create some affordability issues as well. They're expecting that increases in interest rates are going to lead to potentially a 2 to 3% increase again in the percentage of incomes that are going towards housing. So they're expecting this to get worse before it gets better. And they point out, interestingly, in this report that it's going to be the demand side that creates more affordable housing before the supply side does. Now, I find this really interesting because what they're saying, and probably rightfully so, is that we're hitting up against those limits of where Canadians can afford housing. And what that typically means is when we start to get to these super high numbers, the demand starts to go away. It goes away in a couple ways. First and foremost, it'll go away from the perspective of higher interest rates will create less demand, and therefore you'll start to see people have to lower the prices on their houses in order to sell them because there will be less buyers there. But the other way that it'll happen is you'll start to see people move further and further away from city centers, and sometimes, and quite often, into different provinces. So as we're seeing this economy where energy prices are increasing, and we're seeing housing prices in Vancouver and Toronto increase, what you'll likely see is you'll start to see migration from very expensive cities like Vancouver and Toronto to places like the prairie provinces that are rich in energy and also have very much high income to housing cost ratios, where basically you can buy a heck of a lot more house with a pretty substantial income for a lot less money. So that's one thing that they're expecting here, is to see that demand shift from those big cities like Toronto and Vancouver to smaller prairie provinces like Manitoba, Saskatchewan, and obviously Calgary and Edmonton. You could also see it moving towards Quebec or Ottawa. And basically what you'll see is migration and demand will start to shift from very expensive places to lower price places. We are already seeing this. We're already seeing people who are migrating from Ontario to Alberta, or from BC to Saskatchewan. Maybe it's not Saskatchewan, but they're moving around, and the reason they're moving around is because, quite frankly, it is significantly more affordable in different parts of the country than it is in the parts that they're living in. And as a result, we're starting to probably see a little bit of demand start to filter out in those bigger cities, and it's actually starting to pick up. If you look at the reporting with respect to different cities and what's going on with respect to what's happening, what we're seeing is in cities like Ottawa that the long-running boom is leaving its mark on affordability. We're seeing areas like Winnipeg that are full steam ahead. This is largely to do with migration that's happening across provincial boundaries. Regina, good affordability keeps interest in the market high. Again, this is people moving from outside of the province into Regina and using it as a place to buy because they know that they can live affordably. And obviously for where we're at in Calgary, we have a market that's flying high. We have lots of demand. Our neighbor's house is on the market right now. I have never in my life, and keep in mind that the same house sold 18 months ago for about $130,000 less than what it's sold for today. I've never seen in my lifetime the number of people that lined up to see that house in Calgary ever. And RBC points this out in their report that different markets that haven't seen this massive amount of buyer demand are seeing it for the first time ever. So there's lots of interesting things happening. I think it's going to be an interesting time for Vancouver and Toronto's market, especially when you look at it from the perspective of it is quite simply the least affordable it has ever been. So what other needs to happen is we need to see some demand come down and therefore prices start to come down, or we're going to see a very significant amount of time where prices remain pretty flat until incomes start to catch up to those Vancouver and Toronto markets. Because keep in mind that what this pandemic did was it moved the buying preferences and the buying timelines of a lot of people up substantially. We've borrowed buyers from the future in order to have them buy in 2020 and 2021. And what that means is that eventually we're going to start to run out of those buyers, and we're going to see a pretty flat market, or a market that turns fairly soon, at least in theory. And this should especially happen if and when we start to see interest rates go up. Now, that's the big question. Will interest rates go up? How much will they go up? If we see a pretty big jump in interest rates, that's going to affect affordability quite a bit. And I'm not sure that the Canadian economy or the world economy can withstand some big jumps in interest rates for the long term, especially considering that if pretty much everything is going up in price and wages aren't following, that's going to put the hurt on the economy, and it's going to cause some sort of recession that will eventually mean that they'll have to reduce interest rates again. I think we're going to be in this cycle of up and down interest rates for a very, very, very long time. And it's going to take a long time for interest rates to climb up quite high. So, really interesting stuff. If you want to learn more about interest rates, if you want to learn more about home buying process, and so on and so forth, we have a home buying boot camp you can sign up for. We have secrets to getting the lowest interest rate you can sign up for. The link to both of those is in the description below. We also have our down payment challenge that will be starting up again in January. Again, link to that in the description below. And ultimately, if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about a race to 20,000 subscribers and then 25,000 subscribers, and we'll see you on the very next one. Cheers.